The UK is entering a financial era unlike anything seen in years, and most people have no idea how quickly these new tax rules are about to reshape their money. From frozen thresholds that quietly pull more of your income, to digital reporting that changes how you file taxes forever, every update is designed to affect your salary, savings, property, and even the way you work online. These changes aren't distant policies, they're happening right now. And they're already hitting millions without warning. If you want to stay ahead, understanding these rules is no longer optional, it's essential. Number 1. The freeze on the UK's personal allowance and higher rate thresholds has become one of the most impactful financial changes affecting workers today. When these limits stay fixed while incomes rise, more people move into higher tax brackets even if their real earnings barely improve. This effect, known as fiscal drag, pushes ordinary earners into paying more tax without any meaningful lift in their daily comfort. The freeze is confirmed to continue for several years, creating a slow but steady shift where many individuals end up paying a larger portion of their income to the government simply because wages are rising to match inflation rather than increasing true prosperity. For many people, the impact appears small at first, but grows over time. A teacher, retail worker, or healthcare employee receiving modest annual raises can edge closer to the higher rate band, despite living the same lifestyle. Anyone relying on overtime, bonuses, or part-time income may cross thresholds sooner than expected. This pattern heavily affects workers who fall into the squeezed middle, where every deduction matters. With the freeze extended, more owners who were once safely below major tax limits now face unexpected deductions, making it harder to maintain savings, manage bills, or plan long-term financial decisions. Awareness is essential, because the freeze changes how income growth feels at a practical level. Reviewing payslips helps people notice when small income increases move them into new brackets or reduce the value of their tax-free allowance. Individuals managing multiple income sources should estimate their expected taxable income early each year to avoid surprises later. Making small adjustments to household budgets, understanding how allowances function, and keeping track of overtime earnings empowers individuals to protect more of their income. This approach supports better planning and helps families navigate rising living costs during a period when tax rules shape financial outcomes more heavily than before today. Number 2. The recent adjustments to national insurance (NI) rates were announced as a form of relief, yet the real impact varies widely depending on income level, work type, and personal financial situation. While the headline message focuses on reductions for employees and self-employed earners, the savings are often smaller than people expect. This is because the freeze on tax thresholds and rising living costs reduce the actual benefit of lower NI. Many workers receive only a modest increase in their take-home pay, and for some individuals, the difference is barely noticeable when compared with rising rent, food costs, and household bills. The contrast between the announcement and the lived experience has created a growing sense of uncertainty about the true value of these NI changes. For employees, the rate cut offers slight monthly relief, yet it does not offset the broader fiscal pressures affecting salaries. People earning closer to the median UK income often feel the least benefit, as they are already strained by threshold freezes and increased indirect taxes. Meanwhile, the self-employed face a shifting structure where Class 2 contributions have been removed, but Class 4 adjustments still create complexity. Many freelancers and contractors now need to reassess yearly earnings more carefully to avoid unexpected liabilities during the final tax calculation. This makes financial planning more important, especially for individuals with fluctuating income or seasonal work cycles. The most practical step for anyone affected by NI changes is to review monthly income patterns. Understanding the exact difference in take-home pay helps in adjusting budgets and recognizing whether additional income might push someone into higher tax obligations. Workers earning through side jobs, commissions, or overtime should track cumulative earnings throughout the year. Awareness of how NI interacts with other frozen thresholds allows individuals to avoid surprises and make smarter decisions about work patterns, savings contributions, and long-term financial stability.
Number 3. The changes to capital gains tax, CGT, have created a noticeable shift for anyone selling assets such as second homes, investments, or business interests. The most significant change is the reduction of the annual CGT allowance, which means even modest gains are now more likely to fall into taxable territory. Many individuals who previously paid nothing on small profits now find themselves facing new liabilities. The rules also require faster reporting, pushing people to complete digital submissions within tighter time limits. These adjustments place greater pressure on ordinary taxpayers rather than large investors, increasing the importance of understanding how every sale or transaction affects yearly tax exposure. For homeowners, especially those selling rental properties, the lower allowance means a larger portion of profit becomes taxable. Landlords who depend on selling a property to reinvest or settle debts may face higher than expected deductions when closing the sale. Investors holding stocks or crypto assets also see reduced benefits, as gains that were once fully sheltered by the allowance can now trigger charges earlier. The shift influences long-term planning because individuals must decide whether to sell assets in smaller portions, delay sales, or adjust investment strategies to minimize liability. These decisions are becoming more complex as the allowance continues to shrink. The most effective approach is to plan asset sales with clear timing. Anyone expecting to sell a property or investment should estimate potential gains well before the transaction completes. Using digital tools or simple spreadsheets helps track total gains across the year. Individuals with multiple small assets might consider spreading sales across different tax years to reduce the impact of the lower allowance. Keeping receipts, improvement records, and purchase documentation ensures accurate calculations when filing. By preparing early, people can stay ahead of the new CGT rules and avoid penalties related to reporting deadlines. Number 4. The reduction of the dividend allowance has become a major challenge for small business owners, freelancers operating through limited companies, and individuals who rely on investment income. The allowance, once generous enough to cover a meaningful portion of passive income, has now been reduced to the point where even modest dividends trigger additional tax. This shift places pressure on anyone using dividends as part of their income strategy, especially directors who pay themselves a small salary combined with dividend distributions. With the allowance shrinking again, many individuals are reviewing their income structures to understand how much will now fall into taxable bands. For limited company owners, these changes affect how profits are withdrawn. Many directors who previously relied on the dividend model to keep tax-efficient earnings now face higher annual liabilities. Investors holding shares for long-term growth also feel the strain, as dividends that once fell under the allowance now contribute to yearly tax calculations. The shift encourages people to rethink their broader financial strategies, including whether to diversify income sources or adjust their investment portfolios. Some individuals are exploring tax-advantaged accounts, while others are revisiting their approach to salary versus dividends. These decisions carry financial weight and require careful planning to avoid unexpected charges at the end of the tax year. Anyone affected by the shrinking allowance should begin tracking dividend income more closely throughout the year. Reviewing all sources of payouts helps determine how much of the allowance remains available at any point in time. Individuals using multiple platforms or investment apps should consolidate statements to maintain clear visibility over earnings. Business owners can benefit from reviewing their profit distribution plan with a structured monthly approach, rather than making large withdrawals at once. Understanding the new thresholds supports smarter decision-making and allows individuals to adjust their financial habits before liabilities accumulate. This proactive approach reduces stress and ensures people stay aligned with the updated rules without compromising long-term goals. Number 5. The expansion of Making Tax Digital, MTD,
is transforming how millions of people report their income, especially self-employed workers and small business owners earning above £30,000. The shift toward mandatory digital record keeping means traditional paper methods and manual bookkeeping are no longer enough. Individuals must now use approved software to track income, expenses, and quarterly updates throughout the year. This change aims to create a system where financial activity is recorded consistently, reducing errors and strengthening compliance. For many people, the transition feels demanding at first, particularly for those not accustomed to digital tools or frequent reporting cycles. The new requirements affect how individuals manage daily business tasks. People running small local services, freelance operations, or online shops will now upload income and expense details more regularly, rather than waiting until the end of the tax year. This process reshapes how financial planning is approached, because quarterly submissions give HMRC an ongoing view of earnings rather than a single annual summary. While this structure increases accuracy, it also adds responsibility. Anyone with inconsistent income, seasonal work patterns, or multiple revenue streams must maintain updated digital records to avoid errors that could lead to penalties. The shift creates a learning curve for many, highlighting the importance of organized and consistent financial habits. Adapting to MTD becomes easier when individuals start using user-friendly software with automated features. Setting aside time each week to update records helps prevent last-minute stress and supports clearer financial awareness throughout the year. People relying on spreadsheets should consider switching to software approved by HMRC, especially those with growing businesses or multiple transactions. Storing digital receipts, categorizing expenses correctly, and reviewing quarterly submissions before sending them helps avoid mistakes. Learning the new system early allows individuals to build confidence and maintain smoother financial operations. This approach ensures compliance and supports better decision-making as the digital reporting environment becomes standard across the UK.
Number 6. The freeze on the inheritance tax (IHT) threshold is creating a growing financial burden for families across the UK. The threshold has remained unchanged, while property values have continued to rise, pushing more ordinary households into the taxable range. Homes that were once modest in value now exceed the limit due to steady market increases, meaning families can face substantial liabilities when transferring assets to the next generation. This situation affects people who never expected IHT to apply to them, especially those living in high-demand regions where property prices have grown rapidly. The frozen threshold is shaping a landscape where average families experience rising pressure during sensitive life events. The impact extends beyond property values, influencing how people think about long-term planning. Many individuals are beginning to reassess wills, asset transfers, and lifetime gifting strategies to reduce potential tax burdens later. Families dealing with aging parents face the added challenge of understanding complex rules around allowances, residence bans, and thresholds that no longer reflect the current housing market. Rising valuations create situations where siblings or beneficiaries must consider selling property to cover tax liabilities, adding emotional and financial strain. This growing trend shows how a static threshold can reshape wealth transfer for people who once assumed they were exempt. Preparing early is the most effective way to navigate the freeze. Individuals should start by reviewing the current value of their property and assessing whether it approaches or exceeds the threshold. Considering lifetime gifts, exploring eligible exemptions, and documenting asset values helps families create clearer plans. People with multiple properties should evaluate how each asset fits into future arrangements. Seeking early guidance allows families to distribute assets more strategically and avoid unexpected burdens. Staying informed about threshold rules helps individuals protect generational wealth and understand the importance of planning in a housing environment where property values strongly influence future tax outcomes.
Number 7. The updated VAT registration threshold rules are reshaping how small businesses and sole traders operate across the UK. With economic pressures rising, more individuals are finding their turnover approaching the threshold sooner than expected. When a business crosses this limit, it must register for VAT, altering how pricing, invoicing, and record-keeping work. Many small traders who previously remained comfortably below the threshold are now facing accelerated growth due to inflation rather than increased profitability. This creates situations where businesses must adapt their structure even when their real income has not meaningfully improved. The revised threshold environment is pushing many people to reassess their business models. The responsibility of VAT registration introduces practical challenges. Businesses must adjust their pricing strategies because once registered, they must add VAT to their products or services. This can make pricing less competitive for smaller operations serving local communities or budget-conscious customers. Some traders choose to absorb part of the VAT cost, which reduces profit margins, while others increase prices and risk losing customers. The shift demands a deeper understanding of how revenue flows across the year. Companies offering seasonal services or part-time work must monitor turnover more carefully to avoid surpassing the threshold unexpectedly. This increased administrative load can feel overwhelming for individuals managing operations alone. Preparing for these changes involves building clearer financial systems. Reviewing monthly turnover and forecasting future earnings helps prevent unplanned registration, using simple digital tools or affordable accounting software. Supports better visibility and reduces errors. People nearing the threshold should also evaluate whether their pricing structure needs revision before registration becomes mandatory. Understanding how VAT affects invoices, customers, and expenses provides confidence during the transition. Businesses planning ahead can position themselves more effectively, ensuring they remain compliant while protecting profitability. By monitoring their financial landscape closely, small traders can navigate changing rules more smoothly and avoid unnecessary stress during periods of economic fluctuation. Number 8. The rising pressure from council tax reforms and increases is becoming a major concern for households across the UK. Many local councils have approved above-inflation rises due to budget gaps, growing service demands, and financial strain on public resources. As a result, families already coping with higher living costs are now expected to contribute more through council tax bills that keep climbing each year. The situation feels heavier for residents in areas where local services have not visibly improved, creating frustration as costs rise while support systems remain stretched. These adjustments reflect a broader trend of local authorities, relying more heavily on residents to balance their budgets. Another issue influencing household finances is the ongoing review of property ban classifications in several regions. Homes built decades ago may no longer reflect modern valuations, and some properties end up being placed in higher bands after reassessment. This means that two similar houses in the same area could face different tax obligations based purely on updated categorizations. Households experiencing a band increase often face an immediate jump in annual payments. Many people do not realize that their property may be incorrectly banded due to historical data, and the lack of awareness leads to higher payments that could otherwise be challenged. These changes amplify financial pressure during a time when many households are already stretched. The most effective step for residents is to review their current banding and compare it with neighbouring properties of similar size and type. If discrepancies appear, individuals can request a reassessment to ensure their home is classified fairly. Tracking annual increases and reviewing local budget reports helps people understand why bills rise and whether their area is experiencing unusual changes. Individuals experiencing financial difficulty can explore available support schemes or instalment plans offered by local councils. Staying informed and proactive allows households to manage rising costs with more clarity and confidence during changing council tax conditions. Number 9. The recent changes in property tax rules for landlords are creating a challenging landscape for individuals renting out homes across the UK. Adjustments to relief structures, stricter compliance requirements, and reduced allowances mean that many landlords are now facing higher annual tax liabilities. The withdrawal of certain financial advantages has narrowed profit margins, especially for those managing small portfolios or single properties. Rising mortgage rates compound the situation, making it harder to maintain positive cash flow. These changes place greater pressure on landlords who once relied on rental income as a stable and predictable source of earnings. The shift directly influences how rental markets behave. As operating costs increase, many landlords feel compelled to raise rents to offset shrinking profits. This contributes to upward pressure on rental prices, affecting tenants during a time when housing affordability is already strained. Some landlords are choosing to exit the market entirely, selling properties that no longer offer sustainable returns under the current rules. The reduction in available rental homes creates further demand, placing additional strain on people searching for long-term housing. The market imbalance highlights how tax changes influence not just landlords but also wider communities. Landlords can navigate these conditions more effectively by reviewing the financial structure of their property operations, tracking expenses, understanding eligibility for remaining reliefs, and planning maintenance costs carefully can help reduce unnecessary burdens. Individuals with multiple properties should evaluate whether each one continues to meet financial expectations under the updated rules. Using digital accounting tools supports clearer visibility over income and deductions. Throughout the year, landlords preparing to sell should consider timing and market conditions to minimize tax impact. With rising regulatory expectations, staying organized and informed becomes essential for maintaining property investments. This approach helps landlords adapt and remain financially stable while managing increasing operational pressures across the housing sector. Number 10. The growing number of UK residents working remotely for foreign companies has pushed HMRC to tighten rules around overseas income and tax residency. Many individuals earning from employers based in the US, Europe, or the Middle East assume that foreign income remains separate. Yet UK law generally taxes residents on worldwide earnings. As more people take advantage of global remote work opportunities, HMRC is increasing digital monitoring to ensure that earnings paid into international accounts or processed through foreign payroll systems are correctly reported. This shift affects workers who believe they were operating outside standard UK tax structures simply because their employer is abroad. The rules mainly focus on residency status and the source of work. If a person lives in the UK and performs their job from within the country, the income is typically taxable regardless of where the employer is located. Remote workers must understand that being paid in another currency or through a foreign platform does not change their tax responsibilities. Delays in reporting overseas income, incorrect assumptions about exemptions, or unreported earnings can lead to penalties. If DTHMRC identifies discrepancies during routine checks. The rise in digital work arrangements has prompted HMRC to expand guidance and request clearer records from individuals navigating cross-border income streams. Remote workers can manage these obligations effectively by reviewing their employment arrangements and keeping accurate documentation of all payments received from foreign companies. Tracking currency conversions, storing digital payslips, and confirming whether an employer operates a UK payroll system helps avoid confusion. Individuals earning through multiple international clients should calculate their combined taxable income regularly to prevent unexpected year-end liabilities. Using accounting tools that support multi-currency reporting can simplify the process. Understanding the rules allows remote workers to enjoy global opportunities without risking compliance issues. This approach supports long-term stability and helps individuals maintain clarity in a growing international work environment.
The new laws arriving in the UK throughout 2025 show one clear pattern. The system is moving toward stricter rules, faster penalties, and higher financial expectations for both individuals and businesses. Whether it's updated tax requirements, new identity checks for directors, automatic environmental fines, tougher cybersecurity standards, or changes to immigration and travel, every update demands better organisation and faster responses. Even small oversights like late filings, outdated systems, or incomplete documentation can turn into real expenses. The purpose of these laws is to create more transparency, safety, and accountability. But the transition period can feel overwhelming if you're not prepared. Understanding these changes early puts you in a stronger position. By reviewing your financial habits, tightening your paperwork routines, and upgrading outdated processes, you protect yourself from the unexpected costs that catch so many people off guard. Staying informed is no longer optional. It's a real advantage in a system where rules evolve quickly. With the right preparation, these laws become manageable instead of stressful, saving you money, time, and unnecessary penalties throughout the year. If you found this breakdown helpful, make sure to like the video, subscribe for more clear UK updates, and comment which law surprised you the most. And if you want to stay ahead of more changes coming this year, watch the next video suggested on your screen.